that affect an ability to achieve the organization's objectives, but also the organization's efforts to mitigate those unknown risks.
On the other hand, the internal auditor's role in corporate governance is vital, for it provides insights on governance and it provokes positive changes in innovations within the organization and control environment. For further explanation, here is the visual representation of corporate governance framework in 3, 2, 1.
The first one is the shareholders. They are owners of the corporation and has the privilege and right to, number 1, access and examine corporate records concerning governance and financial performance. Number 2, voting rights in the event of election of directors. Number 3, approve any fundamental changes to the corporation such as mergers, sale of assets, and dissolution. However, their roles are limited as they have neither the right nor the obligation to manage the day-to-day business of the enterprise. Next is the Board of Directors, who oversees the conduct of the business and supervises management. Corporate statutes allow directors to delegate certain powers to the officers of the corporation, such as the CEO or CFO. A good example for these certain powers is the responsibility for the organization's day-to-day affairs to the executives. The Board of Directors become fiscally accountable to the shareholders because it sets the amount of dividends paid to the shareholders and how much fund is reinvested to the company. Under the Board of Directors, there is 1. Audit Committee who assists the board's oversight of the company's accounting and financial reporting processes and the audits of the company's financial statements. Number 2. Compensation Committee, whose role is to oversee the discharge of the responsibilities of the board relating compensation of the company's executive officers. And last is number 3, Nomination Committee, who evaluates the board of directors of its respective firm and examine the skills and characteristics needed in the board candidates. Corporations usually have management team once the company becomes too big for the founder or one individual to oversee the entire business. It usually helps the corporation operate with instruction from the board directing the activities of staff members.
Management is also responsible for establishing and maintaining internal control to achieve the objectives of effective and efficient operations, reliable financial reporting, and compliance with applicable laws and regulations. In addition, internal control are the mechanisms, rules, and procedures implemented by a company to ensure the integrity of financial and accounting information and promote accountability and prevent fraud. Also, internal control procedures in accounting can be broken into categories, each designed to prevent fraud and identify errors before they become problems. Number 1 is the separation of duties, which involves splitting responsibility for bookkeeping, deposits, reporting, and auditing. Number 2 is the access controls via passwords, lockouts, and electronic access logs to keep unauthorized users out of the system to identify the source of errors or discrepancies. Number 3 is the physical audits include hand counting cash and any physical assets tracked in the accounting system, such as inventory, materials, and tools. Number 4 is the standardizing documents for financial transactions so it can help maintain consistency in record keeping over time. And the last is periodic reconciliations that ensure balances in accounting system match up with the balances in accounts held by other entities. The control environment is the foundation on which an effective system of internal control is built and operated in an organization that strives to achieve its strategic objectives, provide reliable financial reporting to internal and external stakeholders, operate its business efficiently and effectively, comply with all applicable laws and regulations, and safeguard its assets.